When we start our trading journey in the stock market, we encounter a wide range of candlestick chart patterns. There are more than 100 of these patterns, which makes it tough to memorize every single one. It typically takes around 3 months to learn and retain them. However, I personally think it's not essential to memorize all those candlestick chart patterns. Yes, you heard that right. In today's video, I'm going to introduce you to an advanced technique. This technique will enable you to trade efficiently without having to remember each individual candlestick chart pattern. Let's get into it. But before we proceed, don't forget to hit the like button and subscribe to the channel if you want more premium content like this, absolutely free. We'll catch you right after the intro and disclaimer. Many times, we've noticed market reversals happening even without any clearly defined candlestick chart patterns. However, what many traders don't realize is that there exists a hidden candlestick chart pattern that signals a possible bullish or bearish reversal. The technique used to recognize such patterns is known as blending, where two or more candles emerge to interpret and make informed trading decisions. Before diving deeper into this method, there are some important concepts I need to cover. Be sure not to skip the video so you can understand these concepts thoroughly. Typically, candles appear in two colors, green and red. As most of us know, during the creation of a green candle, buyers push the price upward. As a result, the opening price is lower, and the closing price is higher. This is indicated by the upper wick, which shows the highest price reached during that time frame. The upper wick reflects how much the market moved up during that period. On the flip side, the lower wick marks the lowest price during that same time frame and shows how far the price declined during the candle's formation. In the case of a red candle, sellers drive the price downward from its opening value. Thus, the opening price is higher, and the closing price is lower. The upper wick still represents the high for that period, while the lower wick shows the low. Together, this entire structure is referred to as the range of the candle. Based on this total range, if the candle closes near its high, we identify it as a bullish candle. Take a look at this green candle. Its closing is near the top of its range, making it a bullish candle. Now, if we examine this red candle and compare it to its total range, the closing lies near the bottom. This trait classifies it as a bearish candle. Now let's examine these two candles. Based on their color, the green candle looks bullish, and the red one appears bearish. However, when we compare them using the total range, we see that the closing price for both candles is near their respective lows. So, regardless of the candle being green or red, we'll categorize both as bearish. Take another look at these candles. If judged only by color, the green candle gives a bullish impression, and the red candle seems bearish. But when you assess them in terms of their full range, you'll find that the close is in the middle. This tells us that both the upper wick and the lower wick are equal in size. This type of candle is known as an indecision candle or a doji. In other words, it reflects market uncertainty. It's neither bullish nor bearish. When such candles appear, we base our trading decisions on the candle that follows. Now, pay close attention. There are only 5 core types of candles in the market, and the remaining 100 plus patterns are built upon these 5. The first is the bullish candle. It features a large body and short wicks. It's green in color, and its close lies near the high. These are its variations. We've arranged the variants in order of strength, meaning the first one is the most powerful among them. The second is the bearish candlestick. This one has a large red body, with short lower and upper shadows. These are its variations as well, all red candles. The third is the bullish long wick candle. This candle has a small body, and the upper wick may or may not be present. What matters is that the lower wick is at least twice the size of the body. The color doesn't matter, it can be red or green, but the long lower shadow is the key point. Let's understand why this candle signals bullishness. During its formation, sellers push the price down significantly but fail to hold that level. Then, buyers step in and push the price back up. The candle ultimately closes near its opening. So, this candle shows us that there is strong buying pressure, and that's why it's considered bullish. The next type is the bearish long wick candle. This candle features a small body, with either no lower wick or one that's barely visible. Its upper wick is at least twice the length of its body or more. The color of this candle isn't important, it can be either red or green. Now let's understand why this candle signals a bearish sentiment. At first, buyers push the price significantly above the opening level, but the price fails to hold up there. Eventually, sellers step in and drive the price back down, causing the market to close near the opening. So, by the end of this candle's formation, it's evident that selling pressure has taken over, classifying it as a bearish candle. Next is the indecision candle. This candle has its body placed roughly in the center of its overall range. The upper wick and lower wick are almost equal in length, though their exact size can vary. They may be either long or short. The candle's color doesn't matter here, and it's considered neither bullish nor bearish. These are different versions of the indecision candle. Once this type of candle forms, trading decisions are made based on the candle that follows. So far, we've identified 5 core types of candles. Now, let's discuss how to recognize the hidden candlestick pattern. It's quite straightforward. We'll be using a technique called the blending method. For example, let's take a look at 2 candles. At first glance, it might be unclear whether the signal they give is bullish or bearish. To figure this out, we'll apply the blending technique. To do this, start by noting the opening price of the first candle and the closing price of the second candle. Remember, always use the opening price from the first candle and the closing price from the second candle to form the body of the new candle. Here, the opening is lower and the closing is higher, which indicates a green candle. Next, identify the highest price among the 2 candles. This will define the upper wick, extending from the top of the body. Similarly, the lowest price among the 2 will create the lower wick, extending downward from the body. Now that the blending is complete, a new single candle is formed. Let's determine what type of candle this is. Some might assume it's a hammer, but remember what we discussed. There are only 5 essential candle types. There's no need to recall every name. This one is a bullish long wick candle. It has a small body, minimal or no upper wick, and a lower wick that's at least twice as long as the body. As we've mentioned before, the candle's color doesn't matter here. What matters is the long lower wick. Whether it's red or green, it's still considered a bullish candlestick. Now imagine these 2 candles represent 1-hour time frames. By blending them, we effectively create a single 2-hour candle. This approach allows us to assess market sentiment across different time frames. Let's go through another example. Once again, we have 2 candles, and it's not immediately obvious if the sentiment is bullish or bearish. We apply the blending method, using the opening price of the first candle and the closing price of the second. Since the closing is below the opening, it will form a red candle. Then we calculate the upper wick from the highest point of either candle to the body, and the lower wick from the lowest point to the body. Once again, we've created a bullish long wick candle, even though this time it's red, not green. But as we said earlier, color doesn't define this type. The long lower wick is the key factor. The longer the lower wick, the stronger the bullish signal. Let's examine another example. Here, we have 2 candles. Using the opening price of the first candle and the closing price of the second candle, we calculate the body of the new candle. Since the closing price is higher than the opening price, this will be a green candle. Next, we determine the upper wick by measuring the distance from the highest point of the 2 candles to the body. Then, we calculate the lower wick using the lowest point from both candles relative to the body. Now, this gives us a bearish long wick candle. The body is small, the lower shadow is minimal or non-existent, and the upper shadow is at least twice the size of the body. Some might identify this as a shooting star, and that's valid. But as we've discussed, the purpose here is to avoid memorizing every single pattern name. Now, you might be wondering, we've looked at double candlestick patterns, but how do we blend triple candlestick patterns? It's actually just as simple. Take a look, we have 3 candles here, and we haven't recalled any named patterns so far. At this point, it might seem unclear whether this combination signals a bullish or bearish move. Let's blend them. Again, we start by taking the opening price of the first candle. Since we now have 3 candles, we take the closing price of the third, last, candle to form the body. Next, we find the lowest price point among the 3 candles and extend that up to the body to form the lower wick. Similarly, the highest price point among the 3 candles will form the upper wick from the top of the bod. The resulting candle is a bullish long wick candle. Many of you may recognize that this set of 3 candles forms the morning star pattern, a well-known bullish signal. But think about it, even if you didn't know what a morning star was, using this blending method alone, you could still identify that a bullish price action is underway. In the same way, You don't need to memorize all the different candlestick patterns. Whether it's a double or triple candlestick setup, this blending technique allows you to trade effectively without relying on memorized names. Let's look at one more example, and then we'll dive into how to trade using these patterns. Here we have two candles, and by blending them, we form a new candle. You'll notice its body lies at the center of its range, and both wicks are nearly equal, indicating an indecision candle. Using this method, you can interpret the market by combining 3, or even 4 candles into one. From that, you can form a more accurate trading view. Now listen carefully, we never place trades based solely on candlestick patterns. That's because candlesticks by themselves don't offer strong enough confirmation. Alongside candlestick analysis, we always give importance to other price action tools and trade using confluence. This includes elements like support and resistance, trend lines, demand and supply zones, moving averages, and more. Just because we've learned how to blend candles doesn't mean we apply the technique randomly across the chart. When we face uncertainty around important levels, like trend lines or key support and resistance zones, then it's appropriate to use the candlestick blending method. Let's go through an example. Here, we're at a support level, but the current candle pattern isn't clear, and it's hard to tell what the market is trying to do. So, we blend the two candles. The result gives us a bullish long wick candle. This is a hidden bullish signal, revealed through blending, and we're also at a major support zone. As we know, markets often reverse near support levels. So, when the next candle breaks the range of the previous two candles and closes above it, we have a buying opportunity. In the same way, you can apply this approach to other candlestick setups. Hopefully, this video helped you understand the concept better. Thanks for watching. If you found this video valuable, make sure to hit the like button and subscribe to the channel for more advanced concepts like this. If you have any questions on today's topic, drop them in the comments below. I'll be happy to address them. See you in the next video, and until then, best of luck on your trading journey.